Hey guys, today we're going to be talking about non-concessional contributions, how they can be a useful tool in building up your superannuation capital balance, the importance of utilizing a combination of concessional and non-concessional in order to be able to actually hit your transfer balance cap into your pension, and then what that all means in terms of how you want to structure your assets over time and across different entities utilizing the non-concessional contribution cap. So your non-concessional contributions are non-tax deductible contributions which allow you to transfer funds from your personal environment to your superannuation environment. Now, with all contributions, you have a cap on how much you can actually transfer on an annual basis. With non-concessional contributions, you can transfer $120,000. Now, there's a rule that actually allows you to bring forward the following 2 financial years into the present year with non-concessional contributions. This is known as the Bring It Forward rule. The Bring It Forward rule effectively allows you to contribute 3 financial years worth of non-concessional contributions all at once. There are some rules when we're actually talking about non-concessional contributions and your eligibility to utilize both non-concessional contributions and the Bring It Forward rule. The first thing to consider is age. Now, to utilize either non-concessional contributions or the Bring It Forward rule, you actually have to make sure that you're under the age of 75 in the financial year in question. If at any point during the financial year you were 75 or under, then you actually have access to both of these contributions. If you're over 75, i.e. 76 and onwards, and at no point during the financial year were you 75, you actually won't have access to these contributions. The other thing to think about is what is your total superannuation balance? Your total superannuation balance will affect whether or not you have access to non-concessional contributions and to what degree, if at all, you're able to utilize the Bring It Forward cap. From the 1st of July 2024, if your total superannuation balance on the 30th of June the previous financial year was less than 1.66 million, you can contribute 3 times the annual non-concessional contribution cap over 3 years. That's $360,000. If your total superannuation balance on the 30th of June on the previous financial year was 1.66 million and above, but less than 1.78 million, you can contribute 2 times the annual cap over 2 years. So that's $240,000. And if your total superannuation balance on the 30th of June of the previous financial year was 1.78 million or above, you can't bring any amount forward, but you can still make the current year's contributions of $120,000. Now, if you breach your non-concessional contribution cap, what's going to happen is the ATO is going to send you a notice. So if you've put more in than the allowable balance, you've made a mistake, you didn't quite calculate your cap correctly, or some other administrative error has meant that you've got more in your superannuation than you should, one of 2 things will be possible to do. The first is you actually withdraw the benefit and an adjustment tax is calculated such that the growth and income in the earnings, which shouldn't have been in superannuation, but were as a consequence of the excess contribution, are reallocated to your personal taxable income and taxed accordingly. The second option, which probably isn't a good idea, is you don't withdraw the money from superannuation and the entire value of that excess contribution is taxed at 47%. Now, you'll be given notification by the ATO and you'll be given an option to choose between the 2. Luckily, if you make no choice and you just forget about this, as it currently stands, it'll default to option 1 and the funds will be removed. However, you should still pay attention to this, as in the future the rules might change and that default option may no longer be the case. So in principle, try and avoid making a breach of your contributions, and if you do breach, make the election to avoid the risk of a default not going in your way. Now, the importance of actually understanding this Bring It Forward rule and non-concessional contributions is to understand that for most people, superannuation guarantee contributions and potentially even just supplementing that with concessional contributions, your own salary sacrifice or your own personal deductible contributions, probably won't get you to the pension transfer cap. So the current pension transfer cap is 1.9, looking to increase it to 2 million. If you earn the average income in Australia, it's unlikely that your employment and concessional contributions is actually able to get you to that cap. Plus, it's possible that you've done a lot of personal investing in your own name, such as buying shares or investment properties in your own name, and it may be wise to actually look to transition that over into a tax-free pension, or at least transition the capital over into a tax-free pension. Now, concessional contributions, given they're only $30,000 a year, probably don't have enough power to allow you to do that. That's where your non-concessional contributions are actually quite useful, typically being used in the last decade or 15 years of working life in order to really boost up your superannuation contributions and transition more of your wealth over to that tax-free pension environment, which is extremely useful when we consider the fact that what we actually need in retirement is cash flow, and net cash flow is what we want. And so a pension, which has no income tax, no capital gains tax, and allows us to take a tax-free income from it, is going to be the most tax-effective environment and therefore the easiest environment within which you can actually achieve your goals. If you've got any questions about that, you have any comments, or you'd like to ask us something specific, leave it in the comments and we'll get to it as soon as we can. Thank you and have a good day.